Hello and welcome to my next War and Markets review. Today was a flattish day for the markets. The Nifty, the small cap, the mid cap, micro cap, all were within plus or minus 0.5% in terms of the move. But that doesn't mean the market was flat through the day. It was a very volatile market with a lot of ups and downs during the course of the day. What are the reasons for the same and what's the outlook for tomorrow? If you look at it, well, first of all, today was a Nifty options expiry day today. So that itself leads to volatility. But the volatility index was actually down 2% at about 17 odd. So it was actually eased up in that sense. But what is important is that FIs continued selling today about 3,000 odd crores. And while DIs continued their buying, which we have seen from last week, about 2,000 crores, it led to pressure and the large cap indices ended up slightly in the red. This pattern that's developing, right, is something of very interest, which is that if you look at the advanced decline ratio, there were today 1360 stocks which advanced and 1600 stocks which fell. So clearly, on the broader market, you're seeing that the broader market is a small cap, mid cap, micro cap are doing better than the large caps. And I'd like to spend a few minutes in terms of explaining what's happening. So the geopolitics today again was a geopolitic negative event day because Iran fired a couple of missiles according to their own thing on some UAE and there was a bit of tension and panic and oil shot up to about $114. So that caused a bit of anxiety in the geopolitical front, and naturally FIS, for them that's an important thing and they sold a lot today. And also I think even on the options and the futures market, I think they added about 40,000 new contracts on the short side on the Nifty futures. Options is hard to say today, it's expiry day, so there's rollovers, extensions and all of that. So I'll not comment too much on that. But effectively, FIs had a very bearish outlook, both in terms of Nifty shorts, Nifty future shorts, as well as on the cash market where they sold, right? Now, if you see the DI behavior, they bought, right? Now the point is, what did they buy and what did they sell? If you look at the sectoral indices, they sold the rate sensitives. So today, the stocks under pressure were from the realty sector, the consumer durable sector, and both by PSU banks and the private sector banks, right? And what gained today was defense was the best performer of the day, but to some extent FMCG and consumer and auto also ended up slightly positive. Remember, we are talking about very small movements today. I think defense only was probably up in terms of more than 1%. All the rest of the moves were very small. So what this clearly indicates, and the reason I'm dwelling a little bit on it, is that this pattern that has been following from the second week of April, the markets followed into that pattern. So what is happening is that FIs have been continuously selling, some days below 1,000 crores, some days a lot. But the DIA behavior is that they started off middle of maybe the first week of April by accumulating cash by dropping their buying, and some days they were actually net sellers, and then from last week they started buying. But what are they buying? As you can see, whatever is positive is what they are buying. If you can see consumptions they are buying, defense they are buying. But whatever the FIs are coming and selling, the DI is also allocating some money to that. So the key thing I'm saying is that FIs are constant sellers, more or less. It's the DIs and the retailers who are driving the market direction, but whatever amount they're willing to put into it, right? Because DIs want to keep the firepower for the entire earnings season to deploy, are buying 2,000-3,000. So the market is stepped into a holding pattern that there is broad-based buying across all the cap curve. Obviously, retail and HNI and some part of the DI money is more at the bottom of the market. But in the FIs sell, the large cap index is under pressure because not every large cap they sell, DIs want to buy. For notably today, they didn't buy the banks that the FIs sold. That's why the banking index was under pressure. And IT continues to be something that is reasonably under pressure. So this indicates that the market will, till there is real clarity around the geopolitics front, will continue to be range bound, will continue to be sector rotating because both DIS and retail and HNI investors are tending to buy stocks in the sector where a good earnings has come and exit a sector where it has not come just because they think that one company reporting could reflect the sector view and they want to get ahead of the curve. So this sector rotation and the fact that there's not that much extra money available to DIS because of the heavy buying they did in the month of March. So in this kind of a market, I would say it's actually called an accumulation zone. The one thing is that DIs do have cash reserves to prevent a sharp fall in the market. So if there is heavy FIS selling, then they step up the buying. You can clearly see the pattern, right? I think 2 Fridays, this Friday, last Friday and the previous Friday, FIS sold heavily. But DIs also stepped up the buying on that day, right? So I think you can be reasonably confident that the market has somewhere close to a bottom. The only risk here is if the war escalates tremendously, which is a risk we accept is, but we can't plan based on that. So from all things considered, the war should be reaching a conclusion soon, and there is some development there. I'll talk to you about that. So the strategy then, right, is that this is the best time to buy, because you are saying that there is uncertainty around the earnings season and there's uncertainty on geopolitics. But once the dust settles and the earnings season is done, DIs will have clarity in terms of what they want to buy and what they want to reduce. Retail and HNI both have been displaying a pattern right from the beginning of April that the March correction has already happened to a great deal, and that it's time to average their portfolios. You're clearly seeing that in every single day. In fact, today what's happened is that if you take 1 year return back, the Nifty is flat, but the mid cap and small cap index are up 10%. Why is that? It's because retail and HNI now. This is because of the sharp move recently that is gone into that. So where I'm coming from, again, just to clarify, is that clearly retail and HNI have started averaging their portfolios. The HNIs are obviously from family offices and heavy ticket, so they are willing to put more money behind their stock picks, whatever it is. DIs are being careful, waiting for the earnings season before they deploy. And that clarity, which when comes by the end of the earnings season, they would have pretty much deployed into the stocks and sectors they want to buy. So as a retail investor, I would say that you have to just follow their lead. Obviously, the HNI customers are putting in lump sums and they're willing to take further corrections because they are more risk comfortable and are willing to take that, more risk appetite. But for a normal retail long-term investor, this behavior of the domestic investors is a clue to you to what you should do, right? And because you may not have the capacity to take further hits if it happens, you stagger it, right? So I think that by and large, what I've been saying since the beginning of the war has been holding true, that you stay accumulating, you stay staggered, and you stay diversified, right? Nothing has changed because of today. And now a bit about the market tomorrow, post-market hours, right? Despite Iran firing these 2 missiles, which led to oil spiking up during the day, Mr. Pete Hegseth, the defense secretary, has clarified that the ceasefire is still on, and what Iran's actions have done, the ceasefire has not been disturbed in their opinion. Now, that's been a big relief that the US is not going to retaliate in a big way, and I see oil has already corrected down to 109.7 Brent July futures. So again, there's an easing. So the GIFT Nifty and the US stock market all are in the green now. So the day-to-day basis, you're going to see this volatility, like they say, one day up, one day down. So it's an ideal place for a medium-term person who has already built a portfolio before the war to keep accumulating daily. I hope you all are listening to me and are acting on this, because you would have done that. You would have seen that over the last 1 month, whatever the market has recovered a lot, you would have definitely improved the cost of your portfolio, right? So just to reiterate that the strategy that I've been discussing about every day continues to hold good and is the right way to approach, because the market is now three-way split between three players: FIIs, DIIs, and retail HNIs. And FIIs are negative, increasing their shorts. DIIs and retail and HNI are actually on the long side of it and buying. So as a retail investor, you follow the trend. The only difference being that you don't try to pick stocks and sectors, but you stay diversified and you don't put lump sums and you stay staggered, right? Thank you. Goodbye and look forward to my next.